Everyone, thank you so much for joining our webinar today on stablecoins. So obviously, they've been the killer app of the crypto sphere, and I think that everyone has been pretty primed in terms of everything that's been happening. You know, there's been tons of headlines in terms of more incumbents in the traditional finance space, payments like payment networks like Visa, MasterCard, all kind of getting in this game. So we brought together an excellent panel who's going to talk today about what's been happening, what their take is on all these things. So my name is Duong. I'm head of research at Coinbase. And without further ado, let me introduce my great panelists today. So just to my left here is Richard Widmann, who is the head of strategy for Google Web3. We have Robin Cook next to him, who is Coinbase's legislative counsel. And we have Scott Meadows, who some people may know here, who is our head of partnerships here at Coinbase. So gentlemen, thank you so much for joining me today.
Thanks for having us. Thanks.
Absolutely. So let's just kind of kick off here. Scott, probably first question is to you. Stablecoins have grown to a pretty large market cap and it's been oscillating back and forth, but now we're looking at a $230 billion market cap today. How do you see this role evolving in global finance, probably over the next 3 to 5 years?
Yeah, I think it's fair to say that the stablecoin sort of technology has captured the global imagination in a way and caught fire that I think has always been thought of as being coming on the horizon for the last several years, but as we've seen over the past, I'd call it maybe 12 to 18 months, just dramatically increase in terms of its mind share across not only like the crypto ecosystem, obviously, but more generally across the financial institutional space. I think what we've seen to date, and what really does represent the vast majority of that 230 billion plus of market cap today, is largely still focused on kind of two use cases. One, crypto capital markets generally, as well as what you've seen sort of like local trends towards dollarization in various emerging markets, particularly in the global south, where people are looking for access to dollars in ways, in markets and geographies where you otherwise wouldn't have the opportunity to have access to those. And I think what you're starting to see now, which has really sort of tipped the scales and increased the dialogue around this space, is the use of stablecoins specifically for capital flows and payments. And what we're seeing now is a dramatic uptake in the interest from the traditional financial system to focus on ways that stablecoins can really fundamentally shift the existing payment rails that we've relied on, for the past, that have developed organically over the past, 4 or 5 decades. And those use cases are really starting to come to the fore. I would expect that over the course of the next, I don't know if it's 3 years, but certainly 5 to 7, the stablecoin concept is going to permeate its way throughout the financial system. Fast in some places, slowly in others, but over time, you're going to see more and more more and more applications leverage stablecoins and fundamentally complement existing systems in a way that fundamentally transforms the way we think about the existing plumbing of the financial system. It's starting today with what you could consider kind of the low-hanging fruit and where the places of highest friction are, which generally speaking has to do with when funds cross borders. So as you think about the legacy systems around the correspondent banking network, the SWIFT payments network, and so forth, it's just tremendously inefficient. Moving funds from point A to point B across the globe sometimes costs hundreds of basis points and takes days, if not weeks, to settle. So corporations and institutions with global footprints and global supply chains are really looking at stablecoins now as a way to alleviate a lot of those frictions and pressures. I think that's what we're going to see most adoption with over the course of the next year or 2 or 3. Further down the line, you can imagine the entire capital market system really rearranging itself around tokenization and stablecoins in general as you think about just sort of traditional capital markets. So my sense is that we're still a ways off from that, just given how much inertia there is behind that existing system. But I would expect that over the next 5 to 7 years, we're going to see a fundamental shift in the way that a lot of those markets operate from an infrastructure perspective.
That's a great setup, and I will definitely ask you about some of those cross-border use cases in a little bit. But first, I kind of want to bring Robin in here to kind of give his policy perspective, and we're going to have Q&A later. And Robin's an expert in all things like legal and policy in the U.S. So if you have questions, even outside of stablecoins, and you want to ask him, I'm sure he'll be around to talk about it. But I just kind of want to understand how regulations are shaping some of these developments that Scott's mentioning, because I think we're going to talk specifically about some of the bills that are going through Congress at the moment. But just as an introduction, what are the key debates around stablecoin regulation that are going on at Capitol Hill at the moment?
Yeah, no, thanks, David. And thank you all for having me this morning. I think the way that Scott framed it is the way that Congress is thinking about these issues too. There are two major use cases for crypto today. There's a capital markets use case, and Congress is thinking about that from the perspective of crypto market structure. And then there's a stablecoin use case, and Congress is thinking about that in terms of stablecoin legislation. And I am bullish by nature because on Congress, you cannot have my job if you don't. Have sort of a high degree of optimism, but I really do believe that we're going to see both of those bills signed into law this year. And the president has set a goal of doing it before the August recess. How we get from here to there, I think there are a lot of questions that still need to be worked out. But at a very high level, that is in and of itself very remarkable. Congress doesn't do major financial services legislation very often. It's usually about a once-a-decade exercise. You had Dodd-Frank in 2010. You had sort of the cleanup bill, for lack of a better word, of Dodd-Frank in 2017. You had to wait 7 years to get that. Prior to that, you had Gramm-Leach-Bliley in 1999. You don't get financial services legislation very often. We're likely to get 1 or 2 bills covering those 2 topics done this year, and that is really pretty remarkable. I think the other thing that's pretty remarkable is that crypto is just about the most bipartisan thing in Washington today. There really aren't very many issues at all that are going to get done on a bipartisan basis this Congress. Yet last year, when Fit 21 was on the House floor, you had 279 members of Congress, including 71 Democrats, voting for it. You had people like Nancy Pelosi. You had people like Catherine Clark, who's the House Democratic whip. You have very major folks on the Democratic side that are showing up to this conversation and really engaging in a robust way. What does that ultimately mean for stablecoins? I think it means 2 things. First and foremost, it gets done. That in and of itself is as a threshold matter, the starting point. But it's going to get done in a way that I think is very likely to be durable, because you're having the debate take place now, and you're getting broad buy-in from different segments of the economy. The banking sector is showing up to the debate in a robust way. That hasn't been true for the last several years. You're getting regulators showing up to the debate in a robust way. That also has not been true for the last several years. Everybody's providing their input. Ultimately, Congress holds the pen. It's up to the elected officials to work out what the disagreements are. But the remaining issues, and we can talk about those in detail, but they're all solvable problems. And so ultimately, I have to be bullish. You can't have my job if you're not. But I think that we are setting this market up for the pipes and plumbing for the next 100 years right now.
That bipartisan support is such an important point. I think we'll definitely get back to it when we get into the specifics of some of the legislation we're seeing on the side. But first kind of want to bring Google into this. So Rich, thanks for being here. We saw that Google recently partnered with CME Group to pilot Google Cloud Universal Ledger for asset tokenization. Could you kind of explain how this integrates with stablecoins like, say, USDC, which is Scott's purview for settlement and payments, and what advantages does this offer over traditional banking rails?
Yeah, so I think maybe for folks who are less familiar about kind of the work that we have been doing in this space, GCUL is really an outgrowth of the last, what I would say, 4 or 5 years of what we've kind of witnessed being on the ground, mostly from a developer perspective. And when I say developers, I mean the developers that I think many of you guys are familiar with in the crypto native space, right? These are the guys that are working on the underlying protocols, but it's also the developers that are working inside of places like Coinbase or the large exchanges like NYSE, NASDAQ, CME. And so the GCUL kind of does a couple things. One is it is a bit of what I would say like a tip or a nod to the value that things like stablecoins or tokenized assets bring into traditional capital markets. I mean, just talking about payments right now, one of the things that's like probably the most obvious pain point is all these markets, right? And these venues talking about going 24/7, and then they have these old banking rails, right, that operate 9 to 5, don't function on weekends. So there's just fundamentally like incongruence there with where traditional capital markets want to go, frankly, to keep pace with folks like Coinbase who are actually like paving the way for 24/7 trading and things like that. And then where is the infrastructure that they currently leverage and how they need to close that gap. And so GCUL, right, our Universal Ledger is basically, it's a network, it's a private network that folks like the CME can leverage. And one of the things that we think they will do is leverage it for things like payments, right? You could certainly leverage it for movement of equities or commodities or any other asset. But we see it as an immediate solution for them to be able to perhaps play a role in not just issuing an asset that could stand in for $1 and move 24/7, but also impose some rules around their ecosystem and find partners that they want to work with to kind of bring them on board. I think that when you look at the traditional banking space, and Scott talked about this, like there's a ton of fragmentation. I think the venues who really have a lot of leverage vis-a-vis their partners, their custodians, the buyers and sellers on the exchange, are also a little bit hamstrung by the current payments space. And that is sort of a multi-stakeholder problem. And so unless you can get everyone kind of aligned around the incentives of sort of up-leveling banking rails, you're just going to have all these little holdouts, right, which is what you currently have in the payment space. So we actually think that there's really 2 fundamental issues for stablecoins to kind of reach broad adoption. I think one is the asset itself, right? So we need to have regulatory clarity. There needs to be these structures that exist and almost like a cultural adoption of these assets for payments and like sort of comfort, not just in the crypto native space, but within the traditional finance and accounting teams at places like Google, we were talking about this before this chat, within the treasury teams at a lot of these large institutions who are, again, very sophisticated when it comes to traditional finance, but are still looking at stablecoins and maybe crypto as something that's a bit avant-garde. You need that. And then we think the next thing that folks are going to really look for is determinism from the networks. And that's something that I think GCUL can provide. We don't really see that determinism yet in the public blockchain space, right? Gas fees fluctuate pretty aggressively. There are some high-speed chains like Solana that kind of decrease fees from a transaction standpoint, but have other issues. And there really isn't someone that stands behind the network, right? So if you have a payment drop, you have an outage, there is no Solana help desk. And I think that's just maybe a state of the world for a portion of payments, but I do think that traditional institutions are going to want to keep some of the things about traditional payments there, which is if something gets hung up, if there's a wire issue, in the worst case, if there's fraud or illicit activity, they can contact a custodian, they can contact their bank, they can contact the payment network, and there's somebody who picks up the phone. And so we're trying to really bring those two together in a way that takes and really leverages the best things about some of the things around blockchain technology that I think people do find promise in, with the things that people like about their current payment networks when it comes to accountability and bring those two together. But I do think what we're going to see first is people really kind of dabbling and doing what we did, which is playing in the stablecoin space specifically, just to really understand the value prop there, which is real, and I'm sure we'll talk about in more detail later.
Sure. I have a follow-up, and it's not going to be is Google going to issue their own stablecoin. Although if you ever want to volunteer that information, you're welcome to do so right now.
Not on a recorded webinar.
How does the GUCL GCUL, excuse me, initiative kind of fit into Google's broader Web3 strategy? And what kind of specific problems does it solve for institutional clients?
Yeah, so I talked a little bit about this, right? It's the determinism. So today on that developer side, right, I've been at Google now for 6 years. I came in actually as a lawyer for our finance team. And so the question of what we can do in crypto was very much driven by not this like, I think what happens in the sort of the startup space, which is like the opportunity cost is really nothing. It's either I do something in crypto or I just don't do anything, or I do something else. In the Google context, it's, you have sort of the golden goose, right? You have this business, right, which is essentially a freight train that touches 1 billion users across 9 different products and has hundreds of billions, if not trillions of dollars of payment flows. And so when you start to sort of assess what that will look like from a stablecoin perspective, you really have to weigh what are the opportunity costs there. And so what we started doing very early on is just trying to understand what was the, sort of the directional inertia of the crypto space from a developer standpoint. In other words, just like cloud changed the way that you would build a Coinbase, right? I don't think you could build Coinbase in 2007. You just couldn't, right? You could not run a 24/7 exchange globally without cloud. Much like you couldn't build Uber or many of the mobile apps that we see without Firebase, right? And cloud and Firebase, those are two things that we have worked on pretty heavily to invest in. I think crypto is sort of like another one of these paradigms, and whether it's the asset class itself or the open source networks or the pseudo public markets that allow you to fund these efforts. And so our view is like what we're seeing is developers are building companies differently. And they're capitalized differently today than they were. And that's something that is new that we didn't see in the prior 2 waves, right? So it wasn't just a technology shift that's happening, but it's also an asset class shift. And no hyperscalers offer the ability to pay. They're basically the cloud bill, the number one cost for most of these developers in a payment that is native to the network or native to the asset class that they build in. And so we viewed that as an opportunity to say like, okay, well, what if we offered the ability to pay in stablecoins? And so we've worked with Coinbase and others to kind of facilitate that. And then when we took that to larger institutions and said, do you think this is interesting? Would you want us to facilitate something like this? What we heard was sort of the same thing I heard from my treasury team, which was, hey, I hear you on stablecoins. This is very interesting. I love the ability to have 24/7 payments. I hate cross-border remittances. I'm paying anywhere between 3 and 6% in fees on hundreds of billions of dollars a year. So the TAM is huge, and even just a percentage fix on that nets us a significant reduction in costs. But I don't really have to spend a lot of time thinking about the reliability of the SWIFT network when I'm making payments, or the reliability of, I would say, typically with the reliability of banks. Now that's becoming an issue for treasurers given the SVB stuff, but not a lot of time spent on the networks. In the stablecoin context, there's a ton of time spent on these networks. You have like now a sort of a twofold problem of like, is the asset class structured appropriately, right? Is it bankruptcy remote? Is it regulated under MYDFS or hopefully under some federal legislation soon? And then there is, what is the network it's moving on, and do I have some exposure or risk there? And if so, who's accountable? And that goes back to the other point. So for our strategy, it really was like, it's almost a barbell. There's this crypto native space that's going to lead the charge on stablecoins and these public networks, and we think we need to facilitate that absolutely if we want to be the first stop shop for developers in this new wave. And some of that just involves working with stablecoins in a traditional sense. But we want to take some of those learnings and bring it to our institutional clients and give them another option, of which there is no option today, right? It's really like, I'm on public networks and I can leverage publicly issued stablecoins, or I'm stuck with traditional payments. There really isn't an in-between, and so we want to give them that option, and I think that's really kind of how we're thinking about it in the broader strategy for the company. So it's a little bit of a technology play, but it is also very much almost like a people processes policy play as well, which I think folks in the room can probably agree is one of the big issues that we have in crypto. We have great technology. We don't necessarily nail those last couple pieces when it comes to people processes and the policy.
That's great. That's a great seg, actually, because we've kind of been dancing around the topic of like SWIFT and international kind of payments worldwide. And maybe Scott, back to you, because following up from some of Richard's points, like how do you see stablecoins impacting what you mentioned before, cross-border payments, cross-border remittances? What quarters, applications are you gaining the most traction at this point?
Yeah, I mean, this really, as I mentioned before, is where the majority of the market participants are focused at today, right? Because this is like the obvious, most clear-cut pain point and use case that this technology solves for. One of the interesting things that has started to emerge, though, is as I was thinking about, kind of the question around where's the most traction coming from like a corridor perspective or geographies, or where are you starting to see a lot of this stuff happen? And there are a few sort of common, sort of expected places, and a lot of those tend to be oriented towards markets where there are capital controls, basically, that people want to figure out a way to get around. So if you think about, remittance activity, or what we'll call sort of in the corporate and institutional context, like a repatriation of funds type of flow. You've seen examples of multinationals that have operations in places like Brazil, Argentina, places, geographies in Africa or Southeast Asia and so forth, where getting funds in and out of those systems is just much more challenging and has a tremendous amount of friction. But the interesting thing that I have started to observe a little bit about stablecoins, especially those that are operating on public permissionless networks, is it's actually difficult to identify where the corridors are actually being used, right? Like that's kind of the point. It's not that public blockchains and stablecoins represent sort of like new efficient ways to sort of execute payments in various corridors. It's the idea that they are fundamentally borderless. And I came across an anecdote recently where I was talking to a platform that was building in Indonesia, and they mentioned the fact that there was, they had all these examples of agricultural workers and like farmers, like basically chicken farmers, that were purchasing feed from other geographies and shipping it to them, and they were making all these payments in Tether. And it was just like, it was purely organic, right? Like this was all sort of self-custodial, and driven just by like the natural sort of permeation of this technology into the places where there is the highest level of friction. There's no report or company study that can come out that can tell you how many chicken farmers in Indonesia are using Tether to buy their feed, right? And so while we have a few examples from the likes of, the aforementioned, sort of Brazil corridor, and everybody, has pointed to the example of Bridge, which was acquired by Stripe, helping facilitate payments by SpaceX, who was raising, revenue in Brazil and Argentina and repatriating them back to the US using stablecoins and USDC and Bridge. But like my sense from being out in the market is that that's only like scratching the surface of where this is actually being used. And a lot of it is being leveraged in a way right now that is sort of at the grassroots level that you don't even see, because it's fundamentally on these permissionless networks that it just looks like general blockchain transactions, but it's hard to identify where it's actually happening. And I think what's unique about crypto and the permissionless sort of open network technology is that the development is going to naturally come in that direction, right? And you're going to start to see the adoption. You've seen it in crypto capital markets historically, but it actually starts with the retail adoption and eventually works its way up through into the institutions as they get more comfortable with it. That's different than the way many other technology innovations tend to be driven, right? And it really does sort of throw a unique wrench into our job of trying to like anticipate where this market is going, because the development of this is happening in a way that is fundamentally different than a lot of other technology paradigm shifts that we've seen in the past.
I love that anecdote because so much of this stuff comes from a place of need. I think the entire DeFi sector actually came from a place of need. And we don't frequently think about it. I mean, obviously we're acknowledging it and in spurts and gaps, but it's always good to have a reminder of that. Robin, it seems like, we're kind of talking internationally, but the US is also kind of still defining its regulatory framework, not just for crypto, but I mean, for stablecoins in particular, even though I say we probably have recommendations from the FSB and other organizations in the past. But what's your view on the current regulatory landscape? Like, what do you hope to see in the next 12 months?
Sure. Well, I actually want to just pick up on that last point that you and Scott made, because I think it's a really critical one. It is, I think, the demonstrated need that has brought a lot of policymakers to this party in the first place. You think about this in the context of cross-border remittances and what that means for people's lives. If you are working in this building today and you are sending money home, there are a couple ways you can do that. You can go down the street and pay 9% at Western Union, still pretty slow, or you can do it with 1 second and 1 cent using an app that you can download on your app store. And then on the other side, it is in US dollars. There's a protection for people on the other side against what may happen in their own financial system. In this country, we get the question a lot. What exactly are we solving for here when we have a banking system? We are so fortunate in this country to have a built-out pipes and plumbing that doesn't exist everywhere in the world, and that is just very easily forgotten. And so I didn't want to leave that unsaid, because there are a number of policymakers that we work with all the time who tell us that the reason why they started caring about this issue is because their constituents were telling them stories about how it mattered to their own lives. And it is that grassroots element of it that I think is the difference maker in terms of where we are from a policy perspective. To address your question directly, I think what we're hoping to see is an absence of the fragmented regulatory environment that exists today. So if you are running a major stablecoin, or you're running a exchange like Coinbase, today you have a bunch of different regulatory environments. For Coinbase, we have 45 state money transmitter licenses. We're a bit license under New York DFS. We have a limited purpose trust company under New York DFS. We also are, California recently passed state legislation that would sort of go after kind of a New York type model. Illinois may be doing a similar thing soon. All of that goes away. We have one regulator on the other side, and that's really important because of the fact that this is truly a global marketplace. It doesn't make sense to have this fragmented level of regulation where just between New York and California, the possibility of conflict between those two regimes is like 100%. It's gonna happen. And you know for sure that it's gonna happen. And those regimes themselves are very likely to be in conflict with what's happening in Europe, with what's happening in the UK, with what's happening in Singapore. 80% of the G20 has passed crypto regulation. The United States is falling behind. And so what we're fundamentally hoping to see out of this year is for the US to catch up. What that means on the other side is transformational for this industry and for the people who are building inside of this industry. Set rules, people will follow them. Know what the rules are, people will build to them. I think the thing that has been missing the last several years is that if you have an idea and you want to build, there is a very good reason to not do it in the United States. And in fact, we know for sure that lawyers also in this building were counseling their clients, don't build in the United States. Go to England, go to the EU, go to Singapore, go pick a regulator that has a set of rules that are out there, they're set, they're durable, launch there. And the best projects, the most legitimate projects were being driven offshore. That is such a perverse outcome. That can't possibly be what is in the interest of consumers. And so, fundamentally what we're hoping to see is that by setting rules, two things happen. One, that comes back to the United States, but two, on the other side, consumers are protected because, again, if you set rules and you set the right rules, people will follow them, people will build to them, and that'll just become sort of threshold table stakes for how this industry grows and develops over the long run.
And Robin, before we move on from the policy perspective, we've got the Genius Act, the Stable Act in the Senate and the House. Could you kind of walk us through the reconciliation process that's going on between them? Because there seems to be a lot at stake in terms of state regulators, federal regulators, what the thresholds are becoming a financial operation versus not. Like, can you just walk us through all that?
Yeah, so there are a couple of issues that are still being worked out. One is how to deal with offshore stablecoins that might not register in the United States. In a global marketplace, are we going to keep those stablecoins out? Are we going to make it illegal for an American to hold those stablecoins? Are we going to make it illegal for a U.S. exchange to facilitate transactions in those stablecoins? Those are, I think, thornier questions than they sound, because they go to a lot of fundamental issues of personal freedom, and in a global marketplace that is borderless, where things can flow freely at the speed of the internet, it becomes a real thing to think about. Are we going to geofence certain products out of the United States? And what does that mean for a technology that is sort of built around the idea of freedom in terms of what is coming in and out? The House and Senate bills initially took very different approaches on that issue. They seem to be moving closer together. Where we are in the process, I guess, is actually an important thing to say out loud. Both the House Financial Services Committee and the Senate Banking Committee, with strong bipartisan votes, have passed out different versions of their bills, the Genius bill in the Senate, the Stable bill in the House. And the two sides are talking to each other, working out the differences between the two, so that ultimately they can be teed up to be put on the floors of their respective chambers. So that's one of the issues that needs to be worked out. And the House moved closer to the Senate's position in their version that was passed out, but it's still materially different. And so that's one thing that needs to be worked out. The second is state regulation. There are a number of state regulators, I've mentioned two, New York and California, that have pretty robust regimes for stablecoins already. And there are a number of stablecoin issuers who would like to stay under state regulation. And so what does that look like? Some approaches have said over the years, we shouldn't allow that at all. It should purely be a federal model. I think we've moved away from that. Other approaches have said, well, maybe if you're going to be in a state model, it should only be before you achieve a certain scale. So maybe 10 billion in assets is a number that's been thrown around. I think we're moving away from that too. But there's a third approach, which is that you can just have state regulation full stop, and it can be on par with federal regulation. I think that is, there are concerns that have been raised around that from regulators in terms of making sure that there's a unified floor for regulation across the country, and that stablecoins that are issued under state regulation look basically the same and have the same level of protection as what you'd get under a federal path. So I think that there are ways to sort of solve that disparity, but that's sort of the other remaining big issue that is still being worked out.
Excellent. And Richard, of course, you don't just have to worry about regulation in the U.S. As a global technology leader, you have to kind of worry about everything internationally. You know, you have MiCA in Europe, for example, things in Asia by country. I mean, how does Google navigate the rapidly evolving and sometimes fragmented regulatory landscape that exists internationally?
Yeah, I think, and it's not just us, right? Like any of the large multinational institutions who are looking at this really kind of have a couple of stakeholders they have to consider, right? So the one is maybe like the easiest, which is their consumers, right? The end user, right? So they're people in these jurisdictions who have an interest in, are seeking out the benefits of stablecoins. either due to local FX issues or just payments infrastructure being lacking in the jurisdiction. But one of the other key stakeholders is your regulator. Like right now, I think what we're seeing are a couple things. One is in certain pockets around the world, you're having folks kind of stand out as a leader. I think there's a really big opportunity for the U.S. to do that, right? To your point, in terms of creating clear legislation and hopefully becoming a little bit of that, maybe the lowest common denominator, and certainly you'll have edges, and changes per jurisdiction. But I think that's one avenue that we're hopeful for, is as you get those lighthouses, then kind of the tail end jurisdictions sort of either follow suit. This is much like the securities laws, right? If you look at a lot of securities laws, just going back to like the wonky days when I was doing this work, like Singapore copies a lot of what we have in the 33 Act, right? They just wholesale lift and shift, and that creates a little bit of predictability. Of course, there's always changes, but the idea is you get a bit of maybe it's a quilt, but there's only so many patches in that quilt as opposed to like little squares that are 1 inch by 1 inch over 30 square meters or something. But the idea that regulators are moving towards this and sort of viewing this as like they want to be a facilitator is really, really powerful. I think part of the other stakeholder that's there that the regulators are thinking about, it doesn't necessarily come through, is like the banking institutions, the financial institutions in those countries who are going to be responsible for custodying, transferring, and like building out the infrastructure to enable these payment rails. And that's actually like a really interesting friction that we're starting to see, is some of the regulators who are the most forward-leaning are dealing with their largest participants who are, we'll call them like the tier 1 banks or tier 2 banks that are not as far ahead in their own policy thinking around these issues. And so you're starting to see this rub where the policy is almost coming out first, and it's great policy, but then the infrastructure is kind of lagging, and they feel like they haven't been what I would say is like a vocal participant in the room around those policies. So I think there will be things that kind of get figured out along the way. I mean, our view is a couple things. One is when we do business in a jurisdiction, obviously Google is a large player, and so the most important thing is that we're finding ways to leverage stablecoins that are consistent with the kind of the view of the local jurisdiction, and making sure that it's not being viewed as a way to kind of deal with like capital flight, right? Like I think that's one of the things that as an ecosystem, as a vertical, an industry, we all kind of need to think about more. Because I think the idea of like, hey, I can just use a stable coin, I don't have to deal with capital controls in country A, that door will close, and then what? And big company, like we'll ask those questions right up front, like, yeah, I get this. This is a temporary window. It's arbitrage. The arbitrage will close. Then what? Like, and if I've got hundreds of millions of dollars of capital flowing through this rail that's now shut, what do I do with my business? I now have I have a real like practical issue for my users. Now I also have a policy headache, because that arbitrage has been closed, presumably because a regulator viewed it as a way to escape capital controls. And there's ways to think about that, and I think we need to be very mindful of it. But yeah, I am hopeful that at least the way that we think about it is like creating opportunities to really prove this out in specific jurisdictions where the rails are set up, the infrastructure is there, and the policy is there, and then leverage that to kind of create those proof points and sort of push out and sort of say, okay, well, this is what it would look like. So here we have it in the US. This is what it would look like if we took this to the EMEA markets. This is what it would look like if we took this to Asia Pac. And I think it's going to be very hard for companies to just like turn a switch and like it's like, hey, we have global stablecoin payments everywhere. Like this is great. It's going to be very much an iterative process. But as long as you have those lighthouses, right, that maybe they would call them a beachhead, it becomes very clear that like I guarantee you, and this is already something that's happened here, when we started executing our first couple of stablecoin payments for real value, right, like 7-8 figure transactions, I started getting outreach from other finance teams globally within Google who said, hey, I heard about you guys doing this in the US. Is this coming to us? Can we leverage this? How do we accelerate this? Can we learn? And I think that is, from a crypto standpoint, I love when people reach out and ask these questions, because usually I feel like I'm the one going and evangelizing and saying like, hey, you guys gotta get into crypto, use stablecoins, buy Bitcoin. But when you have other folks in the finance org who are reaching out saying like, I heard about this and I have pain points I think this can solve, then that's the tell. Then there's something of value here, and then really it's just how do you bring that to them in a way that doesn't create net new operational risk for their business. Or net new reputational risk vis-a-vis their primary regulator. But I think stablecoin seems to be this like ray of light or hope in the crypto space, where I think a lot of regulators, they don't want to get left behind. They do see the real value, and they're hearing it from their constituents. And I think they view this as there's a way to bring a lot of their policy prerogatives, not to get into Robin's space, but a lot of their policy prerogatives into this particular area of crypto. I think there are huge questions about like, how do I deal with like the market structure issues around classification of commodities and securities and cryptocurrency, and like how do I deal with whether Bitcoin is similar to something like a Solana or Aptos, or are they two fundamentally different things based on their structure? Those are really hard questions. I think regulators are looking for an easy slam dunk, and stablecoins provide them that in many ways. Because they already have the machinery, they have the muscle memory around regulating currency movement within their jurisdiction. It's just upgrading the technology platform as opposed to creating a whole new asset class.
That's great. So I'm mindful of time. I do want to get to the audience Q&A. Just to kind of conclude, let's do a quick round robin, 30 seconds, 1 minute each. What do you guys see as the most significant development for stablecoins in the next 12 months? Scott, why don't you start?
I think, not to steal your thunder, but I think legislation in the US is going to be fundamentally transformative. And what I think we are paying attention to the most is what that means for participation, particularly from the banks. And how are they going to, because there's an element of once stablecoin legislation passes and it sort of lowers a lot of the regulatory barriers that have previously prohibited these institutions from touching it, what's their response going to be? And one of the biggest questions right now is, will all of them move forward independently to create their own sort of closed loop iterations of these things, which are, in my own view, sort of fundamentally not different than an Excel spreadsheet? Or are they going to be able to sort of get comfortable with the concept of a permissionless network and an open loop stablecoin protocol, and how that system is going to evolve organically over time?
So Robin, Scott obviously stole your answer, but
yeah, well, he did steal, I think, the headline, but I want to do it slightly differently. My answer was also the banks. But mine is the fact that they're showing up. I think in terms of the legislative debate, their policy teams for each of the major financial institutions in the world are all engaged, all of them. That tells you something about the level of interest that those institutions themselves have in this product class, in this future, in this development. And so I do think that this is very top of mind. I think the conclusion is the same. Where does it go from here with their participation? But I do think that it tells you that this is a business imperative for them that they see in the short to near term, or their lobbyists would be using their political capital somewhere else.
Richard?
I would tend to agree with those. I'm going to take it a different angle just to be interesting, and I do think that this is important. I think probably one of the most significant things that will drive real adoption and utility for stablecoins is having non-financialized distribution partners. So right now, the biggest distribution platforms for stablecoins are the exchanges for obvious reasons, right? Because all the frictions we talked about in capital markets traditionally, and they're naturally a great center of gravity for that. I think if we can get the Grabs, the Ubers, the Googles of the world enabling this as a form of payment vis-a-vis not just their B2B clients who are very sophisticated, but also an ads customer or a YouTube creator or somebody who's listening on the Play Store. I think that is going to be a bit of like the generative AI moment for crypto for the reasons that Scott talked about with the chicken farmers before. And it's also going to make very real a thing that I think everyone in this room understands, which is the payment frictions. But anecdotally, we all just see it. It's kind of like Bitcoin, right? It's like you kind of knew something was happening, and somebody would say, "Well, show me a report." And it's like 2013. You're like, "No, there's something happening here. I don't have data to show you other than I'm seeing like inflows and maybe there's price action, but something's happening." And I think the same thing is happening in the stablecoin space. So getting those folks on board will bring this to the forefront of not just crypto companies' minds, but large businesses that have deep retail touch points and surface area.
That's great. So that's where we're going to conclude for the purpose of the webinar.